Hey everybody, welcome to this week's The Informed Investor. Got some more interesting charts for you. We'll take a look at where we have come from, where we are, and where we could be heading here in the markets. Markets are at all-time highs. This chart is from yesterday, so we're actually hit all-time highs again today. So 37 times this year, the S&P 500's hit an all-time high, 9 times in October with still a few days left. You can see how that's broken down through the year. We had a couple at the beginning of the year as the market was still in the rally from last year. Then, of course, we had that dip through March and April, rebounding through May, but not yet to all-time highs. Those started up again in June, and since then we've been hitting all-time highs fairly regularly. Even though as I've outlined in previous videos, seasonality is generally weak through the early fall, September, October months, and much stronger in November, and I'll show you that. But 36 does seem like a lot of all-time highs in the markets. So let's just compare that to previous years here. You can see higher than average, of course, because you've got plenty of years where the markets were down or rebounding from previous lows to get back to all-time highs where there were no all-time highs. But you can see going back last year, we had 57. You go back to 2021, we had 70 all-time highs through that year. So 36, 10 months into the year, not exactly huge. I should say 37 and a few days left in the month, but 2 months left in the year at 36. It's been a good year for sure, but not unprecedented to see that many all-time highs. And let's have a look. The big news today, Federal Reserve as well as the Bank of Canada cutting interest rates. So looking at the results here, when the markets are at all-time highs and the Fed cuts interest rates, what happens next? Of course, usually you think of interest rates being cut when the economy is very weak and the markets are down. So what happens when the markets are at all-time highs? You can see over the next month, a bit of a split there, 52% of the time higher. So short term, very difficult to predict. But over the next 3 months, 74%, as well as the next 6 months, 74% of the time the markets have been higher. And you can see over the next year, every single case, the markets have been higher with an average of 14.3%. So good things to look forward to. The next question would be why or how can the markets move up when they're at all-time highs? What's going to drive that? So short term, we can look at this. This is again the seasonality we were talking about. So usually markets kind of flatten out or even dip through September and October, with the actual bottom of that dip usually averaging out, I guess you should say, to October 27th. We of course passed that date. Not much of a dip in the markets, although we have had some volatility over the last month or so. You can see how strong November and December are in a seasonal perspective. So that's a good sign in the short term. Looking a little more big picture here, and a lot of talk around the valuations of some of these companies. You can see the earnings per share is growing significantly as well. So going back a couple years, how much higher the earnings per share of the S&P 500 companies is. So that growth may not be on the same pace as the prices of the stocks, but you can see that as that growth continues, then the valuations of these companies makes more and more sense. So if we do get a period where the markets come down or markets even flatline and that earnings growth continues to go up, then that valuation makes more sense. So not to say we are quite there, but there is some reasoning on why the markets have grown to where they are and why we keep hitting those all-time highs as that earnings continues to grow in the markets. A couple of interesting charts for you that you can take away here. A lot of talk about inflation today, especially with those interest rates coming down, which will put more pressure on inflation. You can see the highlighted number there, the US, a higher number than it was at 3%, higher than where they want it to be, which is a 2% mark. Of course, lower than it was a few years ago coming out of the pandemic, but being really sticky above that 2% level. And again, more pressure going to be added as interest rates continue to come down. You can see Canada there at 2.4%, also higher than it was at its last reading, but much closer to that 2% level. And then look at the top or look at the bottom if you want some interesting names. Thailand and China, actual negative inflation there. and you look at the bottom, Argentina, which has been a case for high inflation for a number of years, and you can see the 32% is actually lower than its last reading, and Turkey there at 33%. So if you think we've got some inflation issues, just imagine what it's like in those countries. And one last interesting one, I've been bringing up the percentage of the S&P that's in some of these large US tech companies. Well, take those companies, for the most part, the top 10 US companies, and they're 22% of the weight of the global stock markets. And if you just take 5 of those, 16%. So yes, we talk about diversification a lot and being globally diversified. And of course, those things are going to help you because the S&P weightings are so strong and so highly tilted towards those companies. But again, if you're in a market cap weighted index and something bad happens to these 5 or 10 top US companies, it's going to hit hard, even if you're globally diversified by market cap. So another case for diversification into other things, other geographies, other sectors, other valuations, market caps, and alternatives as well. So an interesting chart there, a couple interesting ones to leave you with. We'll see you next time. I hope you enjoyed. Look forward to sharing more charts with you in the future. Take care.